Rakesh, hi, good morning. Great to have you on the show. Firstly, Rakesh, help us understand this, China stimulus measures so far. They've clearly failed to move the needle. But firstly, do you think is there more to come? And can China really sort of push up the economy?
See, the issues which China is facing has, requires some deep kind of reforms. So it's not going to be like a big bang thing which can happen overnight. It will take a long period of continuous reforms to get out of this. Number two is that China probably is preparing for, what policy changes will come post the US elections. And they have been trying to reduce the incentives which they give for exports. So it looks like a thought out strategy to reduce, I would say the tension between the two countries before President Trump comes in. Number three, we have to see, uh, in poll, politicians do promise a lot, but sometimes it's not really followed through post, the elections. So we have to see, what kind of policies President Trump really picks up. He hasn't really tweeted or said anything about it after the elections. So all keeping all this in mind, I think we are in a little bit of fluid situation. Chinese economy is, reasonably supported. They're not going big bang, and China is keeping firepower safe for if untoward all these tariff barriers come in once President Trump takes in. So we have to wait and see. I'm not really expecting any big bang thing here.
So for global markets per se, is this long-lived comeback China trade over?
See, meaning all markets, once they become too cheap, there's some rotation which comes in. So we have seen that kind of thing already happen. From a sustainable point of view, China is past its growth phase and now is more into that slow, steady growth. So clearly, money normally tracks faster growing economies. So China will not get the same attraction which it used to get, for the last 2 decades. So I don't think that is coming back, but periodically, some swing backs might happen.
This view that China comes back, metals go up. Do you see that historical view playing itself, or that is history now? It may not be the current trend.
Oh, see, China does move commodity markets, but the efficacy of those moves are now getting reduced in a very big way. Because what China did in last 40 years, I don't think it will do in the next 40 years. They so I mean, it's no more the same force, I would say, as it was in the last few decades. Having said that, still when I look at a renewable space where I see China aggressively building capacities, and they are some of the major producers across the world, much more a higher market share than what they were even in traditional this thing. So one can't really wish China away. But the issue is that if world is trying to put barriers and China doesn't have any avenues to export, then even in that space, China may not be able to move commodity prices as such. So I agree with you. China is no more that kind of an influencer on commodities, but short term it can swing things.
Okay, fair enough. Wanted to also get in your take as well. In terms of what the projections will be for the second half, because there have been lower steel prices, monsoon, election, all of that have impacted earnings in the first half. So what are going to be some of the key triggers, and what does the second half hold in store?
So the second half definitely is going to be better because one, volume growth comes in. Already we are seeing that in some of the commodities like cement. October was a little bit weak at 5-6% growth because of all the festivity and all that. But November, I'm hoping it will be more like 15 to 18% growth in November. And overall for the sector, probably we could do between 9 to 10%. So volume wise, things are starting to look back for commodities, and Same is the case for steel also. Demand would be much stronger given that we are expecting things to pick up now. So all this will support profitability, but margins is slightly a different story. Margin improvement may not really happen in a big way. There will be improvement because once volume goes up, your fixed costs get defrayed over a larger thing, and your margin tends up a little bit. But per se, conversion margin is not really going up that much because commodity prices are seeing a little bit of a lull at the moment. So we return back to growth in volume, but margins flattish.
Okay, fair enough. And I wanted to just get in a little bit of a take from you on cement as well, because there has been quite a bit of competition, slower pricing growth, and of course the consolidation that we've seen picking up. Do you think as a strategy for investors, it would be better or preferable to stick with the leaders? And what's your outlook on the space as a whole?
Definitely, I think in cement sector, the best strategy is to stick with leaders because they are not only growing organically very fast, but inorganically also they are able to gain market share at a very reasonable valuation. And cement prices don't really behave the way global commodity prices. They are stuck in a narrow range. So probably the surprises on the downside are very limited. And it is just a matter of time when all this consolidation really happens, and cement margins also move sustainably upwards. So all dips in cement can be utilized to accumulate the leaders.
Right. The other thing I also want to talk about is whether or not that 7 to 8% kind of volume band for cement growth, you think, Rakesh, for FY25 is going to be a tall ask.
I don't think so. It's not really a tall ask. Current year was a little bit of turmoil year because of elections and all that. But normally, we would grow at 1.2 times GDP in terms of cement volume growth. And with all expectations of around 7%, 8 to 9% is easily possible for cement industry.
It's great to have you on the show and get in your thoughts on both metals as well as cement. Good speaking with you as always.
Thank you.
If you like this video, then like, share and subscribe to ET Now.